What's going on YouTube? It's Matt Faircloth. Thank you so much for watching. So I am a real estate investor and I've done a lot of real estate deals, but there are other ways that you can make money in real estate aside from owning the property. And I'm here with my good friend Fred Moskowitz. Fred, welcome.
Thank you. Thank you, Matt.
Thank you for joining us because Fred is a note investor. And so Fred's going to teach us today about note investing, and this is something I don't know about. And so if I don't know about something, what I do is what you guys should do too. I call an expert. So I brought in my good friend Fred, who's an expert on note investing, who's going to teach us today about what note investing is. Okay? So Fred, welcome. Right?
Thank you.
I'm going to go 100% from the beginning, right? And this is also helping me out too. Again, I own real estate, right?
Yeah.
So why note investing over, and we'll talk about what note investing is. We're going to whiteboard this whole thing for you guys, so you guys will have some notes here. But why note investing over real estate?
Note investing is something that is very intrinsically related to real estate. As real estate investors, financing is almost always utilized. And note investing is getting involved in the financing side of the real estate. If you are a heavy real estate investor, you own a lot of property, this is a great way to diversify from that.
Why is it bad? Is it better than real estate? And again, you can you're not going to offend me. Is it better in your eyes than owning the actual dirt underneath the property and owning the property itself?
It has some advantages, and certainly a lot of people get into argument, one is better than the other.
Oh, sure.
But both are great. You can make a nice profit with both real estate or on the financing side. And this is just another way to invest. And
this is like being the bank. This is like being, when you're a note investor, you become the bank in a lot of ways. And banks make money. It's what,
And banks are not
pretty good
in
at that.
business to own property. They figured that out long ago. They rather lend money and originate loans and hold those loans.
And you probably do stuff not on single families as well, like other stuff besides single family homes. But let's use we're going to talk through an example and explain what note investing is and how it works by using a single family home as an example. Okay, so here we go. Let's say I've got a single family home that's sitting here, and of course all single family home drawings look just like this, right? With a little, got to do a little smokestack and everything like that. And I've got Joe and Sally Smith that are standing out in front of their property located at 123 Main Street, because of course that's where Joe and Sally Smith live. They live at 123 Main Street, right? So I got 123 Main right here, okay? And there's their door and the little window, and as you can tell, I was an art major in college and everything like that. Okay, so that's Joe and Sally Smith's house. How does the note relate to that?
When Joe and Sally bought their home, they put up a down payment and got a loan from the bank.
So they put some money down into their pocket, and then they bought with a note. Okay. Now they could have bought it with very little money down because there's low money down mortgages these days. So this is the note. Some people call it the mortgage or the loan on the property. Okay. So here is the note, and Joe and Sally Smith make their monthly payments of money to the bank, to the note, right?
Yes.
Okay. Cool. All right. So here's the note right here, right? And then everything's happy and everything like that. So how does the note investor play on this?
What happens is that there is a whole secondary market for loans and mortgages. And what happens is that banks will originate a loan, originate the mortgage, and then
Wells
they'll sell it.
Wells
Fargo, Bank of America. And what you often see is that within 3 months or maybe 6 months or a year, they'll sell the mortgage to another bank. Wells Fargo will sell it maybe to Bank of America. And I'm sure this has happened to many of you. Within a few months of closing, you get a letter from the bank saying, your loan has been sold, and starting next month, you're going to mail your payments to the new lender. Here's their address, here's their phone number, and please be assured that none of the terms and conditions of your loan are being changed. Your payment is the same, your interest rate is the same as agreed.
Right, but this bank sold it to maybe another bank, right, or even an investor.
Yes.
Okay.
This can happen multiple times. And what happens is each time the loan is sold, it's sold at a discount. So this note might have been $100,000.
Okay, right, 100K. Meaning like Joe and Sally Smith, when they bought their house, they bought it for $120,000. So they laid $20K down, Okay, and they borrowed $100,000 from the bank. So that's this bank has a note for $100,000.
Yeah.
So keep going.
And let's say this is at 6% interest.
Okay.
Right?
That's 6%, and it's amortized, right?
Yeah,
So it's getting-
amortized
it's
on a
getting paid down.
30-year, your
Okay.
typical 30-year loan.
Okay.
Now, what happens is when this second transaction happens, the bank's going to sell it for less than $100,000. They might sell it at $90,000 or $95,000.
Really?
Yes.
See, I told you guys I would learn something. I hope you guys are learning something too. So this bank, when they sell it to when Bank 1, right, sells it to Bank 2, right, they're selling it. They'll cut it that much. They'll sell it for like $90,000, right,
Or 95. Yeah, it could be any amount.
$95K.
And you
Okay.
say, why would they do that, right?
Mhm.
Does that make sense? Well,
That is a good question.
Yeah.
Right. Why would they do that?
So there's a couple of key factors. This first bank, they made money on the fees, the origination fees, points at
Yeah.
closing, and so on.
Oh.
And let's say they held this loan for 1 year, right?
It's all interest in the beginning.
It's all interest. So they made 1 year's worth of cash flow payments plus their fees.
Mm-hmm. Right. Okay.
And then the bank wants to originate a new loan. That's their
Yep.
business model, right? So they'll sell this loan and then go back out to their next customer and do a new loan. to
That's one thing
someone
I've
else.
learned from talking to note investors is that banks, guys, are in the business of actually creating loans. They're not so much in the business of maintaining loans or investing in loans. They actually want that loan off their books so they can write another loan. They can create another
Exactly.
loan, right? They want that money back so they can loan it out to somebody else and write
Yes.
another, right? Okay.
Correct. And you see this all the time. You hear about the collateralization of securities and
Yeah.
loans get packaged up and sold. This happens all behind the scenes on the secondary
So is this
market.
95,000? Oh, let's get back to that. But I got a question. This is probably important for the audience too. Is this $95,000 loan at 6% also, or does the interest rate when it transfers?
Yes.
Does the rate change?
No, this 6% stays the same.
Okay.
This loan, this will have a payment of about $599 a month, principal
this
and
loan?
interest. Yes,
You see that math in your head? I love it. 599. $599. Okay. Okay. Cool.
Now, remember what I said earlier. The loan terms never change for the borrower, so the borrower always will be paying this $599.
Right. So that Joe and Sally Smith continue to pay $599 to the bank, and this is another. I should mention the loan servicer, right?
Yes.
That there is an entity that sits in between Joe and Sally Smith and all this mess down here, and that's called the servicing company. Okay. So even though this loan may transfer from bank to bank, you might not even know that your loan got sold because you might continue to make your monthly payments to Wells Fargo or who's a bit Quicken Loans. They're a big servicing
Quicken
company,
Loans,
right? You might continue to make your monthly payments to. There's a few other ones I'm off the top of my head. I can't remember who I make my home mortgage to. But
Wells Fargo. The
They're
lender, yeah, they do need to notify the borrower for compliance reasons. If the
Ceteris.
loan, yeah, Ceteris.
that's
is
a big
one.
servicing company. But
If the loan was sold, even if the servicing doesn't change, they still have to notify.
so the
This is compliance.
servicing is who bills you. Oh, they still have to notify that
Yeah.
it got sold, even though hey, the Ceteris is still going to service your loan or anything like that, right? So the Joe and Sally Smith they'll still make their monthly payment of $599, perhaps through a servicing company or maybe directly to the bank as well. But to keep going, so this $599 is the monthly payment, but now these guys own the loan.
Right.
Yeah.
And now this second lender owns the loan. However, the one thing to consider is they bought it at a discount. So if you run that through financial calculator, if we make this, can we make this 91? If
Yes.
we make this 91, or not for
90
91, that's going to change the rate of return. Now goes up to 7%.
So they bought it for 91.
They bought it for
Yeah,
less.
see, I'll just get my finger dirty for you.
Thank
91,
you.
there you go. Okay, 91. So Bank 1 sells it to Bank 2 for $91,000. So does Bank 2 still get the full $599,
Yes.
or these guys are out of the picture?
No,
Okay.
Bank 2 gets $599.
Bank 1's gone.
Right,
Out of the
out of
picture.
the picture.
Okay. So these guys get $599, and their rate of return on the money is now 7 because they invested $91,000 to get that $599.
Correct.
Okay, cool. And then this maybe flows down to an investor.
This flows down to an individual investor, and even with individual investors, it's the same reason. Why would a loan get sold? Because they need to recapitalize. Maybe they have a new project they're working on. They need money. They'll sell the loan at a discount to make it more enticing to the buyer. And if they've held the loan for some time, they've collected that cash flow.
But Joe and Sally Smith still owe $100,000.
That never changes.
So if they were to come and say, I'd like to refinance my home or pay it off, right?
Yes.
So if this is me instead of a bank, I bought this loan for $91,000. It's worth $100,000. If Joe and Sally Smith come and pay that loan off, I get $100,000 or amortized. Yeah. Maybe they paid some of it down.
There's some pay down, but absolutely the loan balance is still close to here. Maybe it's 99.5.
Yeah.
It got paid down a little bit through the amortization schedule, but bank number 2, they're going to get paid off at that number, loan balance number, 99.5. So now what their rate of return, if you recalculate it, it goes skyrocket.
I want to underscore something, because some of you guys might be asking, it's like, why would bank number 1 ever sell that money for this? Like, they've got a cash flow stream. Why would they sell it? It's because something called the time value of money, right? If I can give bank number 1 $100,000 today for that mortgage, they can go and put it back to work. And as Fred said, we need to underscore this. They can make fees. They can reinvest that capital. They can put it back to work. So they can have that money today to invest back in their business. And yeah, they'll take a discount on it because they can make a lot more than that $9,000 that they air quote lost in selling this at a discount. They can re-up and make multiples of that $9,000 by writing more mortgages, correct?
Yes, at the rate of thousands and thousands. Very high volume that this is
through volume, through writing mortgages and getting a couple of points every time they do a loan and everything like that. So I have a few questions I want to, and let's just say that this continues down to investors and everything like that here, okay? So we're not banks. You and I are not banks. We're individuals, right? So as an investor coming into this space, do I have to write a check for $91,000, or can I collateralize this note? Can I borrow against it, go from can I get a private money investor to come in and work with me on this? How do I do that?
Absolutely. You can find an investor that wants to participate in the note. There's a few different strategies. One of them is called selling a partial, where you're selling off a portion of the note to help collateralize.
Right. So part of this cash flow goes to me.
Right.
And part of that cash flow goes to my private investor.
Yes, and it's usually done in terms of how many payments. You might sell off 5 years of payments. Let's say you have a 30-year loan.
So it's not a pari passu. You don't split it. It's just they get the first 5 years.
First 5 years, and then you get the back 25 years.
Okay.
That's a common strategy. And another way to do it, yes, another investor can lend on the note collateralized by that asset. It's a
so
secure
you
asset.
can leverage it. That's one thing that I wanted to learn today, is that in buying real estate directly, what's great about owning real estate is I can beat Joe and Sally Smith. Remember, Joe and Sally Smith laid $20,000 down and they bought a $120,000 house, right? I can buy that's collateralization, that's leverage. It allows me to control $120,000 worth of real estate for a $20,000 investment. That's what I love about real estate. But Fred's telling me I can do that with notes also. That I can take that leverage conversation and apply it to this too. Correct?
Yes, correct.
Right. That's a lesson for me, because I've always been like, this is a loan already.
Yes.
So how am I going to take out a loan against a loan? But you do it through revenue sharing and through.
There's different strategies. Yeah.
Okay.
Now I know you invest in large apartment buildings.
Yes.
That's a big focus for you. Now, one strategy you can look at is, let's say a buyer comes to you, they want to buy one of your properties, and you will hold financing. You'll originate some owner financing on the property you sold, and you have that. You could go through the same process. You hold it for some time, and then some great deal appears for you and you need that capital, well, you can sell that. You can sell that note at a
Well, that's
discount.
one thing that I've talked about to myself and other people about selling a property here and there. Okay, I'll do owner financing on it. As long as I have a mortgage on it, I can just do owner financing or owner finance part of it.
Yeah.
Well, what if I don't want to be involved in that for the next 15 years or whatever, however long I want to write that mortgage out for? You know, I can sell that revenue stream to somebody else, yourself or whatever, and put that in, you know.
And there's a lot of demand for that. I tell people that selling a note can be more liquid than a property. You can sell a note so fast if you have it priced right and the assets quality is good. You could sell that within a matter of days or weeks. You can reach out to note investors. You can sell a note. Think about how long it takes to sell a property. If you had it and you needed to sell it to raise money, it's going to take you months to get it listed, get it under contract, inspections, wait for closing, and all of that. It takes time. But if you needed to raise quick capital, you can sell either a partial, as I described here, or the whole note, whatever suits your situation.
There's two things I want to bring up here that are for you guys that I want to say as we wind this down. And I wanted to touch on this with you. And this is I'm a value add real estate investor. I want to buy something worth this and make it worth this, because that delta is where a lot of money's made in real estate, right?
Yes.
And from what I understand from talking to you before you and I got started, we talked about a concept called non-performing notes. That is a way to add value to notes, just like if you were to buy a piece of real estate and fix it up.
Yes.
You can buy a note and fix it up, right? You either fix it up and resell it or fix it up and cash flow it, right? So the way I understand non-performing notes to be is, let's say we got Joe and Sally Smith, let's continue to use them as an example, and God forbid they stop making their mortgage payments, okay? This cash flow right here of $599 stops, okay? And then this note is automatically no longer worth $91,000 because it's non-performing. They're not making their payments anymore, right? So give me an example, like if they stop making their payments and they haven't paid in, say, like 4 months, right? And I'm a note investor. I'm a value add note investor. I want to step in and value add to it. Just give me a prediction of what you think, given this. Just let's say the home's in a good neighborhood and everything like that. Just they fell on some hard times. What as an investor could I pick that note up for as your prediction? You know, and I know you're like totally making it up, but like assuming they've been in the house for a while, they were making good payments for a little bit, but they've fallen short. You know,
right. What happens is the value of that note decreases when it's in default, and there's a lot of different parameters that come into play to value that. But you could buy the note at a significant discount,
like
anywhere. Could be, yeah.
So let's say I buy it for $50K, right? So I can come in and buy that note with an investor working with me at $50,000. Now, what I do then is I go, and because I'm the note investor now, I'm now the lien holder, right? I can then call Joe and Sally Smith, right? And say, hey, I'm now your lender and I want to help you. I want to get this note performing again, right? So you can do a remod, a restructure of the mortgage and everything like that, correct? I mean, tell me what you can do. I've got them on the phone. How do I get it performing? What's the process look like for that?
Well, first of all, you should let the servicer handle any interaction.
Oh, so I shouldn't call them direct.
There's a lot of compliance.
See, that's why we have people like Fred in our corner, guys. So I don't call them. I have the servicer
that's
call.
That's better left to the servicers. They're licensed and trained.
Yeah, they know what they can say and what they can't say.
There's a lot of things. But what happens is they'll work with the borrowers, and maybe they fell on hard times, had a temporary setback, and they'll get back on track again, right? So what happens now is your asset, the note value is still lower because of the default, but as time moves on, as that default gets further and further in the past,
I come up with a path to cure with them, right? So maybe if they're behind by like $3,000, I add another $3,000 onto the amount that they owe. Well, I bought it for $50, but let's say the loan's still worth $90. right? That's what they
Yes.
have left to pay down on it. So I say, okay, listen, Joe and Sally Smith, I'm going to add another $3,000 to the loan amount for what you owe on the back. I'm going to bring it back onto the back of the loan. And am I allowed to reduce their monthly payment to help them out? I mean, can I?
As the lender, you can do anything that you want.
So
you can reduce the monthly payment.
So I'm
Or
gonna
you
maybe
defer.
push some money on the back end. I'm gonna lower the interest rate. I'm gonna do whatever it is. So listen, Joe and Sally Smith. Instead of $599, you're now gonna pay me $450. Okay, I'm gonna take $3,000 and put it on the back end of the loan to get you caught up and everything like that. So now you're gonna pay $450 a month, right? And so then Joe and Sally Smith say, "I'll do it. That dog will hunt." So they start paying $450 a month. For how long before the loan is viewed as worth more than $50K?
I would say 12 months
Okay.
is a good time. If it's only 3 months, investors are going to value it a lot lower.
Right.
But if they see 12 months, that's solid.
Right.
And if it's 36 months,
Forget it.
it's even better.
So I can take this, and at 36 months, it might even be viewed close to 90 again, right? So I could take this $50,000 investment, get them performing, and by the way, I'm making cash flow that whole time, okay? I'm making cash flow at $450 a month, and then eventually this loan could be, I'll be even more conservative. I said I could sell it for 80, right? I sell it for 80K, okay? Excuse my handwriting. I sell it for 80K a year or two from now. But this is equivalent to what you guys would refer to as my buy and hold investors. This is a value add deal. This is a fix and flip, and I can either enjoy the cash flow long term as you would if you're fixing up a rental property and enjoying the cash flow on it. I can also fix up the property and then sell it and liquidate it as you would a fix and flip, right? That's what's great about note investing is you can apply the same technology that we do here in buying something for this and adding value to make it worth this, and then either cash flowing it or selling it, right?
Yes.
Cool. So Fred, as I wrap it up, tell our audience here how they hear more about, how do they connect with you, how do they find out more about what you're up to as a company, and tell us briefly in a couple in 30 seconds about your business and how they get a hold of you.
Absolutely. I have a book coming out in a few months.
Congratulations.
And thank you. And I have a special offer for the listeners and the viewers. If you text the word note to 555 888
888.
you'll be able to sign up to be notified about the book launch, the upcoming book launch. And what I'd like to offer is
So text note the word to 555-888.
Yep.
Okay, cool. Keep going.
the first 10 people that from this channel that sign up and register, I'll send them a free copy of the book when it comes out. So
You're going to get a lot of text messages, Fred, because you just gave a freebie. Okay, so guys, text note to 555-888. Text the word note, and if you're one of the first 10 to send that, Fred's going to send you guys a free, capital F, free copy of his book. Do you have a website or other means for people to get a hold of you?
People can go to my website. It's fredmoskowitz.com.
Okay. How do you spell that?
It's FRED.
Yep.
MOSKOW.
FRED-MOSKOW-ITZ. FRED-MOSKOWITZ. And that'll be in the show notes on this video too, guys. FredMoskowitz.com.
Yes.
Cool. Thank you. This has been really educational. Yeah. Guys, note investing. It's a great other way to make money in real estate, and you can diversify your portfolio. This is not a reason why we should all sell all of our real estate and get into note investing too, but it is a great way to diversify and consider other investments as well. So Fred, thank you for being here. I really appreciate the education. Thank you for watching, guys, and have a great profitable week.